So today's webinar is going to be a little bit different in that we don't have a PowerPoint or slides or anything. But Boris Muscheyev, I get it right? Close.
You never get it right.
I know. Yeah. I had one guy. I had one of my best friends and he was a vendor back. I've known him since 2003, and I went 10 years without pronouncing his name wrong. He never would tell me. And somebody else told me like 10 years later, and I finally figured it out. So it does happen.
All good, all good.
So anyway, Boris, I'm gonna let Boris talk about himself, but he's a CPA, a tax planner, and I trust him. He does my work. I hired him a couple of years ago, and I trust him and what he says. And so he's helped me a lot, and I wanted him to, he's gonna give you like 5 tips on things you should be doing, and then we're gonna open up for questions. You can put them down in the Q&A section, and he'll answer any questions you got. All right, so Boris, you can take it away, and I'm gonna get out of the scene until you get through, and then I'll come back in.
Okay, sounds good. All right, awesome. Hello, everyone. My name is Boris Muscheyev. We'll just do a short introduction so that you know who I am and build some credibility with you, right? So why am I the one here talking about taxes and year-end planning? Like I said, my name is Boris Muscheyev. I'm a CPA, but I'm also a certified tax planner. I graduated Baruch College here in New York in about 2010, and I was sucked into the world of traditional accounting, grinding through tax season, preparing tax returns, doing almost 500 tax returns during tax season, and that's 500 returns in 3.5 months. So I was really burned out. To say the least. I was burned out. There was no value to my clients. No value really to myself. And my clients were overpaying in taxes because I was just doing tax preparation. So I decided, okay, something needs to be done. And I ventured out on my own, and I started a tax planning firm. I got certified as a tax planner. And really, I've chose to work with self-employed attorneys and law firms throughout the country. We currently have clients in about 20 states right now and growing. And we mainly offer tax planning service, and that is pretty much providing tax strategies for law firm owners and self-employed attorneys to be able to save money on taxes. So Ken reached out to me. Ken is actually our client as well, and he works with a lot of attorneys as well. And he reached out to me and said, "Hey, let's do a webinar." I said, "Sure." And I was talking to him yesterday, and I'm like, "By the way, I just want to let you know there's like no slides, right? Doing these webinars in the past." I found it to be very beneficial is that we're going to do this, we're going to talk about some things in the beginning, but we're going to open it up for Q&A. You can ask questions. We're not just going to leave 5 minutes in the end to the questions, but it's really, we're going to open the floor up to the questions. So you can ask any tax questions in your particular situation, and I will do my best to answer those questions. About 95% of the time, I can answer them right there on the call, right? Depending on the complexity of the tax question. But one of the things we do want to talk about, and like I said, I work with a lot of attorneys, so I've seen common mistakes that they do on their taxes. And so one of the things we want to talk about is, 5 year-end tax planning strategies. What can you do 5 things before the year is over? So with that being said, we'll start with number 1. So one of the things I always notice with attorneys, self-employed attorneys, specifically those in personal injury space, right, is that, first of all, God bless them, very profitable business. They do great by their clients, and they have those profits. And most attorneys, what they end up doing is that, when they have those profits, they never get a proper guidance on how much to pay themselves, what their salary should be. And very often when I ask them, well, how'd you figure your salary? Well, they said, I don't know. I mean, I guess I have to, right? Some accountants tell them just to zero out their entire profit, make sure there's not much in a bank account, take it all out as a salary. So what you want to do right now is that reassess your compensation. You should have an owner compensation package, right? What that means is that the IRS specifically says, do not underpay yourself, pay yourself reasonable compensation, but do not overpay yourself as well, right? They don't really say it in those words, do not overpay. They say you need to have a reasonable compensation. So if you are taking out all your money as a compensation, or majority of your money from the company as a compensation, it's time to reevaluate that and pay yourself a reasonable amount. Because think about it this way. You as an owner of the business wear many hats in the business, right? You're not only an attorney, you are also to some extent do some clerical work. To some extent, you're a paralegal. To some extent, you're doing some billing and invoicing or some bookkeeping, right? Whatever that is. When you break down your tasks by categories of how much time you to devote out of the year, out of the week, right, into each category, you'll see that you're not an attorney 100%. You're a business owner, so you wear many hats. An attorney would typically be paid a lot more for providing these services than somebody who's doing bookkeeping, clerical, paralegal work, and so forth. So when you break that down, your salary goes down, right? And then you can determine how much to pay yourself. We obviously use a software to do this, all of that, but your accountant should be able to help you with that. If you guys have any questions, we can always provide some guidance. But the main point of this is that to make sure you have a compensation for yourself that is reasonable and you're not overpaying yourself. The second thing you want to include in that compensation is health insurance. As an owner of the business, the majority of the attorneys are set up as an S corporation, right? If they're not, then in most cases they should be, but everybody's situation is different. Before you make that decision, always speak to a tax advisor about whether that's a smart decision. But most of them are set up as an S corporation, and as an S corporation owner, if you own more than 2%, you're not allowed to receive any fringe benefits from the company, right? For example, such as health insurance. But the IRS says, okay, fine, we will let you take that health insurance, but only if you include it as part of your compensation. So owner package compensation. And I love that. The reason is because when you include health insurance as part of your compensation, it actually reduces your taxable FICA income, right? Meaning to taxable FICA W-2, meaning to say you don't have to pay FICA taxes on those premiums if they're part of your compensation. 99.9% of my own experience, this is not a statistic that I saw online, but 99.9% of the time, I have not come across a business owner that actually does this properly, or an attorney owner, right? But if I take all the business owners that I've worked with in the past in my career, they're not doing this properly, and they're really missing out on a simple savings, which could be $2,000 to $3,000 or $1,000 a year, just including as part of the health insurance as part of that compensation. At the same time, you could be saving additional money on taxes by lowering your compensation. So really, by reassessing your compensation by the end of the year, you could still save some money, but we are approaching the year end. So you could start now and then continue it into the next year, especially if you include your health insurance. The second thing we want to talk about, or the third thing, right, in this case, home office deduction. Now, a lot of people say it's an IRS red flag, and it's a myth, right? It used to be an IRS red flag, maybe in 80s when working from home was not really such a common thing. Right now, especially with pandemic, it is a common thing. It's totally allowed by the IRS. And if you do it properly, you can have your home office as your, even if you have an office location, which most attorneys do, right? They have a physical office location. You can deduct it. Definitely speak to your accountant. If he says, I cannot, maybe you should fire him, right? You cannot deduct it if you qualify, right? But the point is you are able to deduct it because here's the thing, right? Look, when President Trump's Tax Cuts and Jobs Act came out, this is always like a tongue twister for me. When that law came out, they said, all right, from now on, nobody can deduct the more than $10,000 in property taxes and state and income taxes on your itemized deduction. That put a huge dent on some taxpayers. Obviously that tax law had a lot of other benefits, but for that particular purpose. So then I start stressing even more the importance of deducting your home office, because guess what? The property taxes that you're not able to deduct on your personal taxes, you can funnel that through the business and deduct it as a home office and reimburse yourself tax-free from the business, right? We had a personal injury attorney client to whom we just delivered a tax plan about a month ago, bought a home. I think it was over $2 million. I mean, interest on that, the property tax and everything else, and that's just huge, right? Cannot deduct the whole thing from the from personal. Well, guess what? Can funnel it through the business because he has a legitimate home office, right? So definitely make sure you implement that. And if you're not implementing it, start doing it right now. Also, I want to talk about maximizing your retirement account as we are approaching year end. The most common mistake I see with attorneys, right? either one of them, right? Even either they do not have a retirement account, or if they do, they're not really maximizing it. And Ken knows all about it because we kind of like fixed it all up for him, right? Basically, when you have a retirement account, let's assume you have a 401k in your business and you guys have a 3 or 4% match. Majority of attorneys, what they do, at least the ones that we come across, they do the 3% for their employees and for themselves. So if they're making $100,000, they put away 3,000 and the company puts away 3,000, and they think that's it. That's the maximum they can contribute per year. Well, that's wrong, because you, as an owner employee or employee owner or any employee in America, right, that works for a company that offers a 401k benefit plan, any employee can take up to $19,500 from their paycheck and put it and oh, give me a second. There's a pop-up. Okay, great. Sorry about that. You can take up to $19,500 from your paycheck and contribute it to your 401k. Okay, so that has nothing to do with 3% match. Your company will still put 3%. If you make 100,000, the company will put away 3,000, and you can put away 19,500 from your employee. That is called deferral. Your employees can do that if they want. It doesn't hurt your pocket, it hurts their pocket, but it gives them tax benefit because you have an advantage because you're a business owner. You can do 19,500, and if you're over the age of 50, you can do up to $26,000, right? And especially if your spouse works for the business, that's a whopping $52,000 if both of you of deductions if both of you are over at the age of 50, and under the age of 50, $38,000, right? So maximize your 401k. Make sure, one big advice I can give you, whatever it is that you can take away from this webinar, the big advice that I can give you is that you always want to make sure that your accountant and your financial advisor, they're not independent of each other, meaning to say in terms of communication. You must make sure they communicate. Your accountant should be following up with your financial advisor, and your accountant should know what type of retirement accounts are there. I'll be honest with you, that is probably not the case. Your accountant probably knows the general, the general, I guess, structure of the retirement accounts. I didn't either. I took it upon myself to learn it because I knew how much it will benefit my clients, and I know exactly how to bring it up to them, show them the benefits, and then we talked with financial advisor and say, can this be implemented and how can it be implemented, right? So that is super, super important. And another thing that I want to talk about also in this will be the last thing, a Roth IRA. So, now Roth IRA is not a tax strategy that will save you money on taxes right now, but it can save you a lot of money on taxes at your retirement. So some of you know, some of you don't know. So I'm just going to cover the basics very quickly. The regular retirement account, whether it's a traditional IRA, SEP IRA, 401k, right? You take a tax deduction now, put it into a retirement account. It has investment earnings. And when you're ready to retire, you take that money out and you pay taxes on that. Roth IRA, on the other hand, is something that you contribute after your tax dollars. It has investment earnings. And when you retire, when you take out the principal which you contributed and also the earnings, you do not pay any tax on it, right? So the maximum that you can contribute to a Roth IRA is $6,000. If you're over the age of 50, that is $7,000. Now, when you're over a certain threshold, I don't remember what those thresholds are in terms of income, you cannot contribute to your Roth 401k, to the Roth IRA. But you can use a strategy that is called a backdoor Roth IRA, okay? It's a backdoor conversion. It's totally allowed. It's nothing illegal. All the financial advisors know about it. Call your financial advisor. If he doesn't know it, he's probably not a good financial advisor, right? He really should know these terminologies. But you call them, you say, hey, I want to, so basically the backdoor Roth means you open up a traditional IRA, you put the money in there. You cannot take a deduction, even though you could. Generally, it's tax deductible, but you will not be able to because you make too much money if you're over that threshold. But that's okay. Then you call your financial advisor and say, I just contributed to a traditional. Please convert it to Roth within that same year for the tax year, and they'll be able to do it. Okay. So, and those retirement savings can grow tax-free every year. Okay. I did say that's the last thing we're going to talk about. Sorry, it was the fourth thing. And the fifth thing that I want to cover also, an HSA account, a health savings account. Basically, it's better than a retirement account, better than traditional and better than Roth. If you qualify, which in majority of my clients do because they have a high deductible, you can put money away into the health savings account if you're married up to $7,100 a year and use that money to pay for your medical expenses, but not your health insurance premiums. So how does it work? So basically, the health savings account is not like a traditional retirement account where you take the money in, you take a deduction. When you take it out, you pay tax on earnings and principal. No, it's not like Roth where you put after tax money and you take it out tax free. It's better. You put the money into the health savings account, you take it as a tax deduction, and when you take the money out to pay for medical expenses, it's tax free, including any earnings it had. Now, you could be young right now, you don't have medical expenses, but that's okay. That's building your health retirement account, so to speak. So let's say in 30, 40 years from now, you have more medical expenses. You can use everything that accumulated in health savings account to pay for that. It's an easy deduction right now, and it's also not taxable to you at the time when you use it. So super, super huge. We always stress that to our clients. And I think majority of our clients follow this advice and they open one up if they do qualify. So those would be my 5 things that I would recommend. Definitely, there's obviously a lot more tax strategies, right, that you can do. But those are the 5 things. And I think, Ken, if you have any questions or if I said something too quickly, you want to clarify, please go ahead, and then we'll open up the floor for questions.
Yeah, I got a couple quick questions before we open it up because I think we got some questions coming in. And we talked about this yesterday on the podcast. 179 deductions, and then the deal about prepaying expenses. Trying to defer income. What's the deal on that? As far as how does that work?
Yeah, great question. So let's start with prepaid expenses, right? So this is where you come in and you're like kind of do planning for yourself. Like, do I need to prepay any expenses? Sometimes it looks like you need something like, oh, I'm going to have such a big profit this year. What can I do to kind of, get rid of this cash and write it off? Seems good at a time, but might not be the best decision that you could make. First of all, the IRS allows you to prepay your expenses, certain expenses. For example, you can prepay your rent or anything that has a 12-month contract. It's based using the safe harbor rule. You can prepay that, pay that in December. Your vendor receives the check in January. You can write off the whole thing as an expense. But should you do it? That's the question. And these are a few things to consider. Are you going to be in a higher bracket next year, especially in a personal injury section? You could have bigger settlement cases paid next year, right? Maybe you need this deduction next year rather than right now. We should also consider the fact that Joe Biden's tax policies could come to fruition, right? And if that happens, you might end up in a higher bracket because his tax plan is focused on really, really taxing anybody making more than $400,000. So are we going to be in that tax bracket? That's another thing we want to take a look at, because sometimes prepaying expenses could mount up to about $100,000 if you have a high rent, right? Or some high insurance, whatever that other expenses that will qualify. So can you do it? Yes, you can. Should you do it? That's something that you should analyze in detail. And as far as the Section 179, so Section 179 in the IRS tax code basically says if you purchase assets for your business, let's say you purchased, you moved into a new building and you purchased furniture equipment for the office, furniture, computers, and all that stuff. Basically, it allows you to write off your assets. Instead of depreciating it over 5 or 7 years, you can write off the whole thing in 1 year. And that is the Section 179. But we have another thing that was put into law after TICJA, Tax Cuts and Jobs Act, right? Which is the bonus depreciation. Bonus depreciation means when you bought the same property, let's say the same assets, and you get to write off the 100% of it. Before it used to be only 50%, but now you can do 100%. So you might say, well, what is the difference between Section 179 and bonus, right? Sorry, my Vonage is popping up on my computer. I don't know if you hear that.
Oh, yeah.
Let's see. That should fix it in a second. Yeah. Okay. So the difference between Section 179 and bonus, you might say, well, Boris, what is really the difference? Well, let's take a closer look, right? With the Section 179, let's say you bought a lot of assets and it produced a loss for your business. Well, the Section 179, with the Section 179, if it produces a loss, you cannot write it off. The excess after your profit has to be carried over to the future years, which is okay. That means you'll get a deduction next year. Or let's say you need this loss this year. We work with a lot of attorneys that have other ventures, right? Or they own real estate properties, or they own other things, and they need that loss. Then I would say, well, why don't we do the bonus depreciation? Which bonus depreciation, if doing the depreciation will result in a loss, then it will help you this year on your taxes. Is that clear so far?
Yeah.
Okay, awesome.
So the 179, the thing, and we talked about this yesterday, the thing I love about it, and there's usually a cap on it, but it's usually like $1 million or 2 million or whatever, or $500,000. But you can buy this stuff on credit. Like I'm saying, you could go out and buy a whole new phone system for $80,000 and pay $8,000 down and then finance it over 5 years, but you still get to take the whole $80,000 that year if you want to, right?
Right, exactly. Mm-hmm.
This just got to be in service. You got to have bought it and be in service by December 31st. So I did that one year. We bought a bunch of computers because, I think it's a good time if you've got that. Hope you got that problem, is to go through and look at all your computers and anything that's over 2 or 3 years old, dump it and get new ones, because they become obsolete after 3 years anyway. So I think that's a good thing to do.
Right, and also, like, if you know you're going to be upgrading, right, and you need that deduction right now rather than next year, for example, just go ahead and do it before the year end.
Yeah.
Upgrade your system. If you know you're going to be doing it next year anyways, just go ahead and do it. It's similar to doing the prepaid expense strategy, right? But again, a lot is like questionable about, are we going to have a new tax law? Can we, some of the income, can we take it now rather than deferring it to next year? Because next year we could be in a higher bracket, right? And can we, defer the expenses rather, right? So really planning, but a lot is obviously unknown. It depends if we have the Republican Senate that will still retain its seats, then most likely most of those majority of Joe Biden's tax policies might not pass the Senate.
And the one thing I want to clarify is, at the beginning you were talking about paying yourself salary. I guess that's, if you got to have a subchapter S or election so that you can pay yourself a salary, or can you just pay? If you got to be a certain type of corporation to be able to do this?
In most cases, right. So you have to be either an S corporation or a C corporation. Majority of attorneys, like I mentioned earlier, are set up as an S corporation. Some are still operating as a sole proprietorship or a single member LLC, right? And there could be variety of different reasons for that, right? So we're not going to jump, like, we see a lot of CPAs say, well, you need to be an S corporation. Or we have some clients coming, I want to be an S corporation. It's like, wait, hold your horses, right? It's true. Generally, an S corporation is the best entity. It is true. But do you have other businesses that are producing income? And if they are, and if you become an S corporation, then you're really your company is going to be paying extra Social Security, Medicare taxes. The whole detail about it, I'm not going to get into details on that. It's very technical, but really those things should be looked at. But to answer your question, to pay yourself a salary, you do need to be an entity such as an S corporation or a C corporation.
Yeah. And I think, I know, because we've done it, is you sent me some kind of test software, a test that asked me, 50 questions, and then it came up with what would be a reasonable salary for me.
Exactly. So we do use a software. You basically, it's an interview. It's about 15 minutes of your time. You already did it, Ken. You know that. Yeah. You answer questions about what you do in your business or how much time you devote, right? So that software actually uses your demographical area, the labor statistics, and everything else, and gives you a good estimated salary. Not what 100% it should be, but a good estimated salary based on your geographical location, your demographics, and the type of work that you do. Like an attorney in New York is probably going to be getting paid more than an attorney in most of the states, right? At least. Same thing with California. So it takes all of that into account. And it produces an estimated salary report for you, which meets the IRS criteria. If you're ever questioned on it, this report can be provided to the IRS saying, we followed the steps and we kind of figured out what that salary should be.
So Stephen Schwartz says, could you explain one more time about adding health insurance to part of compensation to save money? Where you add that health insurance,
Adding health insurance to part, yes, great question. So Steven, sorry, I had a pop up. Okay, so if you're paying health insurance premiums from for yourself or even for your family, right? And you're probably paying it out of the business. And if you're paying it out of the business, when you have an audit, it will be added back, right? It will not be allowed as a deduction because you're not allowed to take a deduction on a business return for your health insurance premiums for yourself or your family. You're not. And the way you can check this, right? If you look on your 1040, the personal tax return, under deductions, it'll say self-employment health insurance. You need to deduct it there. But in order for you to deduct it there, it's really weird, to be honest with you, how the IRS has it set up. Honestly, I always say it for the past, I don't know, 8 years since like I've been looking really into this. It's like it's weird how they have it set up to you for you. But they say take it in your compensation. So whoever is your payroll provider, you want to give them a call and let them know to include the health insurance as part of your compensation, and you'll notice a difference on your FICA tax withholdings. Now, I strongly do not recommend calling the payroll provider on your own. Speak to your accountant, and if your accountant is aware of this, he will call with you and make sure it's implemented. With our clients, none of them will let them do it on their own. If they do it, we ask to, we request the pay stub because it's important, because many times the payroll provider, the rep that picks up the phone, might not know what you mean, but most of the payroll providers we've seen, all the major payroll companies have that option. It's called more than 2% shareholder health insurance, but definitely do it with your payroll provider. And another thing I wanted to add to that is, no, I think that was it.
Okay.
Cool. I
So,
hope that answers the question.
Somebody said, what about simply taking the Medicare max at 137.7 as your salary?
You can, right? Yeah. You definitely can. For example, if your business, you're netting $500,000, you take 500,000 minus 137, you're saving the Medicare tax on the difference, but Social Security is already maxed out. Or what if your salary is supposed to be $100,000? Yeah. That's an estimate of like additional $5,000 in savings. I'm not saying that that's what it should be, right? But what if it is? I've got clients who are actually personal injury attorney clients that are stepping away from the big picture of being an attorney in the firm, meaning to say they've put all the procedures and policies in place for it to operate on its own, right? The cases are coming in, they already know what to do. They got 10, 15 attorneys working, and it's more like from the bigger management picture, right? It's not an attorney anymore, right? So what if you redo your salary? Maybe it's supposed to be more than $137,000. We also want to make sure we're in compliance as well. In some cases, we do these reports for our clients, and their salary has to be more. Well, that's what it is then, right? Because you also want to make sure you're in compliance as well.
Yeah. So HSA account, gentleman said, I thought I was told that an owner cannot get tax deduction now, only the employees on the.
Oh, that's an awesome question, Stephen. You are right. You cannot take deduction under the business, right? And remember what I said earlier, as an 2%, more than 2% shareholder, you cannot receive any benefit. So you cannot set up an HSA account, or you can for your employees, but you can't qualify. But you can qualify for it personally, right? Because you're opening your health insurance personally under your personal name, so you can get an HSA that way, under your personal and funded from your personal funds.
Okay.
And Ken, I think we had some questions in the chat as well, and not just in the Q&A tab.
Yeah, we do.
Before, so let's take a look at those as well.
Yeah. Are you saying we can purchase a whole house through the business, even if only 10% is designated to home office? I don't think you mean that.
Are you saying we can purchase a whole house through the business? Yeah, that's not what I meant. I'm sorry if that's how it came out. What I meant is that you can have your own personal residence where you live. And if you have a designated office area, whatever that is, let's say it's 10% of the home or 15% of the home, then you can just write off expenses based on that percentage. So if your mortgage payment is $1,000 per month, 15 mortgage interest, 15% of that is $150 deduction.
Okay. And what if I asked you this yesterday, HSA, if you put the $7,000 or whatever it is, $7,100 in there and just let it grow for 20 years and then decide to take it out and not use it for medical expenses, what's going to be the penalty?
You will pay tax on the contributions, and I believe on anything that it earned. Okay. And there's going to be a penalty as well. I can't say what the penalty will be from 20 years from now, but I know there's also a penalty right now. I don't remember what the penalty is from the top of my head, but it's a certain percentage, excuse me. So, you can do planning based on that also. Well, if it'll grow, let's say 15%, I'll pay 10% penalty. Is it worth it? But I would not bet on the future. Because we don't know what presidential candidates we have and how they view the tax code. And, HSA could be wiped out. You don't know.
Yeah. So to be safe, you need to do it this year, I guess would be the best plan. Or you can wait and see what happens. Well, we won't know the Senate races until January. So
yeah, for Georgia state. So that will really be crucial to deciding if the Republicans do remain in control of the Senate, then most likely, Joe Biden's tax policies will not pass, or majority of it at least.
Yeah. So airplane deductions. Can you buy a jet card, or do you have to buy the whole plane? They come out with it when they come out with a new tax law. You get to write 100% off if you buy a jet or something or airplane.
Yeah. I cannot speak to that question. You can reach out to me privately, and I can get back to you on that.
Yeah. All right. Yeah. Anybody else got any questions? I think that's all I see right now. But okay, please recap 5 things. Just like 1, 2, 3, 4, 5, I guess. Give a list or tap. Yeah.
All right, awesome. So I'll recount it here over the webinar because I'll be typing, just take too long, right? So number 1, reassess your compensation, right? What you want to do is that speak to your accountant, whoever you work with, or you can always reach out to us. Find out if you're paying yourself a reasonable compensation. If you're paying yourself reasonable compensation, and if your health insurance, personal health insurance, or the health insurance that is set up from the business, but for your health insurance premiums is part of your compensation, okay? Because that could save you a few thousands of dollars on taxes. The second thing we talked about was take a home office deduction, okay? Especially right now with pandemic, a lot of people are working from home. If you qualify for home office, even if you have another office location, okay, you can still qualify to take a home office deduction if it's classified as an admin home office. And what that means is that you do majority of the administrative tasks at home, billing, bookkeeping, invoicing, all that stuff, right? Then this qualifies as a home office deduction. The third thing we talked about is maximizing your retirement. A lot of attorneys do not maximize their retirement. If they have, for example, a 401k with 3% set up, they just do 3% without realizing that you as an employee owner or any employee could put away up to $19,500 into their retirement. That means you can take up to $19,500 from your paycheck to put it into the retirement. We also talked about setting up a health savings account and contributing money to your health savings account. If you qualify, can get you a nice deduction, and also build a tax-free retirement for yourself by doing a Roth contributions every year. You might not qualify for Roth contributions because of your income limitation, but then you can do what's called a backdoor Roth IRA conversion. Your financial advisor should know about this. You basically put the money into traditional and convert it to Roth on the back end. So that's why it's called a backdoor Roth. And I think those were the 5 things.
Yeah. And the 179, I think, well, yeah, that was the 5 things. I asked about the 179s. I did have one more thing. Okay. Any other questions? I want to remind everybody that this month is actually National Mastermind Month, and we have some openings. Our meetings are starting in December, and we've got 2 groups that are filled up, but we have 2 other groups that we still got a few spaces left. If you're interested, you can give us a call, see if it's something you're interested in. And for our members that are on this call, I sent out something on the listserv about an hour ago. We've been having some questions about the Google screen, the LSA ads, and what's going on and why everybody was doing great for the first 30 days and then they just fell off the map. I think I've got the answer. I put it out there. We're going to have somebody next week for our members to come in and you can ask questions. We're going to get into it more deeper, but I think that was kind of something I want everybody, don't forget to look at your list or your emails, look at the list, or it's something I put on there about 1 o'clock. Anyway. So Boris, thank you so much. And thank you for helping me save about 40 grand in taxes last year.
Yeah, no problem. And by the way, We just discussed the 5 strategies on the call, but if you guys want know about 61 strategies that attorneys can use, one thing we did not mention is that I've also authored and co-authored a couple of books. And one of the books that I have out there is Tax Secrets for Attorneys. Like I said, we specialize working with attorneys. You can get a copy of our book for free, actually, if you go to pilmataxcpa.com. Again, that's pilmataxcpa.com. It's going to redirect you to our website. If you schedule a consultation call with me, you'll automatically get a PDF copy of the Tax Secrets for Attorneys, about 61 tax strategies that attorneys can use. And yep, thanks for putting it there, Ken. I think you only sent it to panelists, so we need to send it to.
Oh yeah, I need to send that. Yeah,
just do that to all participants and attendees. Yep. So again, Pilma Tax CPA will be more than happy to assess your current tax situation and provide you with comprehensive tax saving strategy. Ken, thanks so much for having me on this webinar. I hope this was really helpful.
It was. Thank you. Okay, until next time, this is Ken Hardison, dedicated to your success. Thank you and have a good week.